Hello viewers, we'll be going over gold and silver futures. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, and the day-by-day forecast for gold and silver. So let's examine gold futures on a technical analysis. On the 1 hour chart, we are at nearing overbought RSI, and if we expand out further to the 4 hour chart, we are approached to positive MACD and we have not reached overbought RSI yet. And on the daily chart, we start to see a divergence in play for the daily MACD, and I do see a possible resistance that was made back in April 14 at around the price of 1762. So that will be our first immediate resistance. If we continue to move up higher, we did attempt to touch that level today, and throughout the day we decline a bit. And as for support, if we do manage to reverse and head down lower, the next support that I see is the 18-day moving average, this purple line, and that did act as our previous support back in April 20th and also acted as previous resistance back in April 6th. And since we're above resistance, that now acts as our support. So again, that support is around 1695, and if we do head down lower, that price movement is roughly around 3.2% to the downside, and if we do head up higher, that price movement is roughly around 56 basis points. So let's examine the day-by-day probability model. On here, let's examine where gold futures will head to in the next coming days. So on the 7th day, we have a 39% chance for gold to climb higher between 0 and 4.6%. On the extreme case, we have a 5% chance for gold to climb higher between 4.6 to 9%. On the other hand, we have a 50% chance for gold to fall between 0 and negative 4.6%. And on the extreme case, we have a 5.5% chance for gold to fall between negative 4.6% to negative 9.2%. Again, these models are now available in the link below. So let's examine the day-by-day forecast for gold futures. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. So the current trend is this blue line on the line graph, and overlapping it is a trend that I believe is the best match, and this trend dates back to May 9th, 2011 to August 3rd, 2011. And right here we have our current trend, and below is the 2011 trend. So let's compare the both trends. So on the current trend, we start off at the upper Bollinger Band, dip down, touch the middle Bollinger Band. Again, we reach the upper Bollinger Band until we reverse down, touch the bottom Bollinger Band, and finally towards the end we did manage to touch the upper Bollinger Band. And on the trend in here in question, we did see 2 points where we do touch the upper Bollinger Bands. In between that, we touch the middle Bollinger Band. Afterwards, we dip lower to touch the bottom Bollinger Band, and right towards the very end, we reach the upper Bollinger Band. So what we have here is 1, 2, 3, 4, 5 points. On the current trend, we also have 1, 2, 3, 4, 5 points. So there's reason to believe if the trends and patterns are the same, the outcome and forecast should be fairly the same. So the model that we just examined was, I would say, if I can find it, it was May 9th, 2011 to August 3rd, 2011. Back then, gold climbed around 5. And if we head back to the day-by-day probability model, that coincides with this standard deviation of 5%. We only have 5% chance for gold to climb between 4.6 to 9%. So let's examine the technical performance of each model. Our current trend we're in is up 0% from monthly high, up 15% from monthly low, up 1.5% from 10 simple moving average, up 4% from 20 simple moving average, and up 7% from 50 simple moving average. Now the trend that we just examined, May 9th, 2011 to August 3rd, 2011, it was down 2 basis points from monthly high, up 10% from monthly low. up 2% from 10 simple moving average, and up 3.7% from 20 simple moving average, and up 6.5% from 50 simple moving average. So these two trends have technical similarities. And now let's examine silver. So silver futures, on the technical aspect of it, we are up 1% today on the 1 hour chart. We were touching overbought RSI, and we're slowly encountering resistance. And on the 4 hour chart, we have not reached positive MACD. However, I do see us reaching above to positive MACD very soon. As for the daily chart, we are also reaching to positive MACD, but we also see a slight divergence in play as well. We are encountering resistance on the 50-day moving average, this yellow line, and that resistance is around 15.7 cents. And if we do manage to break above that 50-day moving average, the next resistance that I see will be around the price of $16.45. Reason why, we had that as our support, and since we're below support, that will now act as our resistance. And if we do manage to head down lower, the next support that I see is around the price of $14.20. And we did see a support level back in April 31st, or I should say March 31st. So if we do manage to climb higher, that price movement is roughly around 6.5% to the upside, and to support level, that price movement is roughly around 8.3% to the downside. So let's examine the silver day-by-day probability model. So as we progress to the 7th day, we have a 55% chance for silver to climb between 0 and 9%. On the extreme case, we have a 33% chance for silver to climb between 9% to 18%. And on the other hand, in extreme case, we have 11% chance for silver to fall between negative 9% to negative 18%. So let's head to the day-by-day forecast for silver. So as the days progress, we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. The blue lines are current trend, and overlapping it is a trend that I believe is the best match, and that dates back to August 11, 2011 to November 4th, 2011. So let's compare the two charts. Right here we have our current trend, and below the trend that I believe is the best match. So what we have here on the current trend, we start off at the bottom Bollinger Band, touch the upper Bollinger Band, once more touch the bottom Bollinger Band, and revert back to the mean to the middle Bollinger Band. And on the trend in question here, we start off at the bottom Bollinger Band, climb higher to touch the upper Bollinger Band, reverse down once again to touch the bottom Bollinger Band, and revert back to the mean to the middle Bollinger Band. And one thing to note, there's an attempt to make a second peak at this trend here. On the current trend, we do not see that second peak, so do take that into consideration. So what we have between these two trends, we have 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points on the current trend, so there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was August 11, 2011 to November 4, 2011. Back then, silver was only up around 1.3%. And if we head back to the day-by-day probability model, that coincides with this standard deviation, 55% chance for silver to climb between 0 and 9%. So let's examine the technical performance of each model. So we have our current model. We're currently down 21% from monthly high, up 21% from monthly low, down 11 basis points from 10 simple moving average, up 3% from 20 simple moving average, and down 2% from 50 simple moving average. Now the trend that we just examined was August 11, 2011 to November 4th, 2011. It was down 28% from monthly high, up 13% from monthly low, up 1% from 10 simple moving average, up 4% from 20 simple moving average, and down 3% from 50 simple moving average. The only technical difference between the two trends that we just examined was this is a positive above the 10 simple moving average. Compare that to down 11 basis points from 10 simple moving average. So do take these considerations into account. And again, these models are now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.